Chapter 14. Money and Banking. Do you remember your first summer job? Whether it was babysitting, delivering papers, or mowing lawns, think of how long it took to save just a few dollars. And most of us learned just how valuable those few dollars were once they were spent on something. Money is one topic with which we are all familiar. This chapter describes the different forms that money takes in the nation's money supply and discusses the different types of financial institutions that make up the Canadian financial system. It also looks at how financial institutions create money and describes the means by which they are regulated. The functions of the Bank of Canada are discussed, as are the tools that it uses to control the money supply. The learning objective of today's lesson is that at the end of this lesson, you will be able to define money and identify the different forms it takes in Canada's money supply. Understand the different kinds of financial institutions that make up the Canadian financial system and explain the services they offer. Explain the functions of the Bank of Canada and describe the tools it uses to control the money supply. You will also be able to explain the role of alternate banks, specialized lending and savings intermediaries, and investment dealers in the Canadian financial system. Understand the concepts and activities in international banking and finance. What is money? Money is any object generally accepted as payment for goods and services. The characteristics of money. Although usually thought of as paper or coinage issued and authorized by a government, money is actually any object generally accepted by people as payment for goods and services. Desirable characteristics of money include portability, should be lightweight and easy to handle; divisibility, should be easily divisible into smaller parts with fixed value for each unit; durability, should not spoil, and even when it eventually wears out, it can be replaced; and stability, the value does not fluctuate drastically. The functions of money. Money serves three functions: as a medium of exchange, as a store of value, and as a unit of account. The spendable money supply. Buyers and sellers must agree on the value of money. The value of money depends on its supply, money in circulation. When money supply is high, the value of money drops. When money supply is low, the value of money increases. M1. Money supply. Measuring the supply of money is difficult and there is little agreement on how it should be measured. M1 is the narrow definition of the money supply and includes only the most liquid forms of money, that is, currency, and demand deposits. M2. Money supply. M1 plus the convertible money supply. M2. This broader definition of the money supply includes everything in M1 plus items that cannot be spent directly but that are easily converted to spendable forms: time deposits, money market mutual funds, and savings deposits. Credit cards and debit cards. Plastic money. Spending with a credit card creates a debt, but does not move money until later when the debt is paid by cash or check. Credit cards are a money substitute. They serve as a temporary medium of exchange, but are not a store of value. Debit card transactions, in contrast, transfer money immediately from the consumer's bank account, so they affect the money supply the same way as spending with a check or cash. The Canadian financial system. The main function of financial institutions is to facilitate the flow of money from sectors with surpluses to those with deficits. Until recently, the financial community in Canada was divided rather clearly into four distinct legal areas. They are chartered banks, alternate banks, life insurance companies, and investment dealers. The legal barriers between them have been eroding, permitting previously disallowed activities. Financial Pillar Number 1, Chartered Banks. These privately owned profit-seeking firms serve individuals, businesses and non-business organizations as a financial intermediary offering a variety of services. There are only a few banks in Canada, but each one has many branches. Both Schedule A and B banks are regulated by the Bank Act. Services offered by banks. Banking is highly competitive, so banks do much more than simply accept deposits and make loans. 1. Pension services. Most banks help customers establish savings plans for retirement. 2. Trust services. These involve management of funds left in the bank's trust. For example, the trust department will manage customers' investment portfolios. 3. International services. 3 common services are currency exchange, letters of credit, and bankers' acceptances. 4. Financial advice. The bank recommends different investment opportunities. 5. Electronic funds transfer. Combines computer technology to transfer funds or information into, from, within, and among financial institutions. This includes features such as automating banking machines, which allow customers to bank at almost any time of the day or night. Pay by phone allows customers to authorize specific regular deposits and withdrawals, direct deposits and withdrawals, point-of-sale transfers. Customers can pay for retail purchases with a debit card, smart cards, which can be programmed with electronic money, and mobile digital wallets. Credit and debit card information embedded in smartphones allows consumers to pay for groceries and shop for clothes using their mobile devices. Bank loans. Banks are the major source of short-term loans for business. Secured and unsecured loans, interest and the prime rate of interest are discussed. Banks as creators of money. Banks use money deposited with them to loan to others who, in turn, deposit it in banks where it is used further. Changes in banking. In addition to the technological changes, banks are also dealing with deregulation, changes in customer preferences, and international banking. 1. Deregulation. Banks are moving away from their historical role as intermediaries between depositors and borrowers, and are diversifying to provide a wider array of financial products for their customers. 2. Changes in consumer demands. Because consumers are no longer content to simply bank money when they can earn more with it elsewhere, banks are responding by selling a variety of corporate and government securities. These changes are leading to changes in the profit base of banks, which previously was the spread between interest charged on loans and interest paid to depositors and now is increasingly fee-based. Banks are increasingly involved in selling insurance. 3. Changes in international banking. Canadian banks are experiencing more competition because foreign banks are now allowed to do business in Canada.